The focus moved this week from politics back to more traditional economic drivers of markets. For now, it appears the Quitterly fears are behind us. The weekend G7 meeting saw limited market reaction, although there are obvious differences of opinion regarding trade, and the Trump-Kim North Korea summit passed without disruption. So the major focus of the markets was back to the Fed and the ECB meetings. Firstly, the Fed hiked the Fed funds rate target band a quarter point as widely expected. The Fed upgraded their near-term growth projections and raised their assessment of current conditions to solid from moderate. The market focused on their projections, the dots as we call them. These showed an uptick in the median expectation to 4 tightenings this year from 3, although it was just via one member upgrading their outlook. Altogether, the dot profile shows the same number of hikes expected from 2018 to 2020, albeit front-loaded. This was followed by the ECB meeting overnight, who also delivered a tightening message, although did it with a commitment to keeping rates on hold. The ECB announced that they will halve the pace of their asset purchase program from €30 billion per month to €15 billion per month during October through December, and they gave a commitment to hold rates steady at least through the summer of 2019, and in any case for as long as necessary. ECB President Draghi's press conference gave a cautious outlook and discussed rising uncertainties. Their GDP forecast for 2018 was downgraded from 2.4% to 2.1%. All this discussion of continued monetary support really contrasts with the Fed outlook we discussed earlier and saw the euro fall 2 cents against the US dollar and European equities and bond prices move higher. Domestically, the focus was on employment markets, which have been a source of cautious optimism for the Australian economy. Firstly, Governor Lowe spoke on wages and productivity and reiterated that wages growth is needed to see inflation return to the target, although he also outlined several cyclical and structural factors which are holding wages growth low. The domestic employment data on Thursday didn't really change this outlook, and it looks as if the jobs market has lost the momentum we saw in 2017 as we move through the first half of 2018. For May, we saw a soft jobs update of just 12,000 jobs, although the unemployment rate fell to 5.4%, but this was due to a falling participation rate, particularly amongst males. The US dollar has been the strongest G10 currency this week, and arguably has room to run higher as an additional rate hike for 2018 is embraced. Of course, trade and US deficit concerns remain, but this huge contrast in monetary policy settings versus almost all other major markets should remain the case well into 2019. The Australian dollar has been the weakest G10 currency over the week and is close to its year-to-date lows. Commodity prices have done okay, as have domestic data, but the outlook of an RBA on hold for a very long time continues to weigh. Next week, the data calendar is quiet domestically and the focus will be on the RBA. We see minutes of the June meeting, as well as Governor Lowe speaking at a central bank forum. If the US dollar continues to find support given its yield advantage and the policy outlook in the wake of the Fed meeting, then Aussie dollar could test its 2018 lows around 74 cents. We'll be back to talk to you next week.